You often hear news reports about countries buying more from abroad than they sell, and it can sound like a major problem. This kind of imbalance, where a nation spends more internationally than it earns, often raises immediate concerns about economic health. It might lead you to wonder if this situation is universally negative for a country's financial future. No, a current account deficit is not always bad for an economy. It is a complex economic indicator with varied implications that depend heavily on its underlying causes and how it is financed. Rather than a simple good or bad label, it is more accurate to view it as a symptom that requires deeper analysis to understand its true nature. The reason why a current account deficit is not inherently negative lies in its composition and the flow of capital. A current account deficit essentially means that a country is importing more goods and services and paying out more in income than it exports and receives. By definition, a current account deficit must be offset by a surplus in the financial account, meaning that foreign capital is flowing into the country. If this foreign capital inflow is used to finance productive investments such as new factories, technology, or infrastructure, it can fuel economic growth and improve future productive capacity. This type of deficit reflects international confidence in the economy's prospects, drawing in foreign direct investment. To determine if a current account deficit is sustainable and beneficial, you should look at what is driving the deficit. Examine whether it is primarily financing investment in capital goods that enhance future productivity, or if it is merely funding excessive consumption. You should also assess the national savings rate and the stability of the capital inflows. A deficit financed by long-term foreign direct investment is generally considered healthier than one funded by short-term, volatile portfolio investments or increased government borrowing for non-productive spending. One key concept to understand here is the intertemporal trade-off. A country running a current account deficit is effectively consuming or investing more today than it is producing, borrowing from the rest of the world to do so. This can be perfectly rational if the borrowed funds are invested in projects with high expected returns that will enable the country to repay its debts and increase future output. An example of this is a rapidly developing economy that uses foreign capital to build up its industrial base, eventually becoming a net exporter. Ultimately, a current account deficit is a reflection of a nation's borrowing from the rest of the world. Its impact depends on whether these borrowed funds are channeled into activities that boost future economic capacity and allow for sustainable repayment, or if they are simply used to sustain current consumption levels. By understanding these nuances, you can move beyond a simplistic view and critically evaluate the true implications of a country's external balance for its long-term prosperity.